Good afternoon, and thank you. I want to do one thing before I begin, which is something that I did earlier today, and I'd like you to join me. In that little box behind us are the two women who are doing the simultaneous translation. It's very difficult work, and I can tell from listening to the English translation from Korean that they're doing it marvelously, and I think we should all thank them for the work they've been doing all day long. Thank you. Brian Kim gave you a wonderful portrait of an extraordinary landscape of change, with page after page of opportunity, of technology, of change, and it seems very daunting. I think it is very daunting. I want to talk and bring the focus down to mid-sized companies, middle-standing enterprises, middle-market companies, and I want to talk about how these companies cope with this landscape, how they look at it, how they walk through it, or in some cases run through it, how they survive in it, and in some cases do not. I'm going to talk about capabilities and portfolios when it comes to innovation in middle market companies. Very briefly, I represent the National Center for the Middle Market, which is a research center at The Ohio State University at the Fisher College of Business in Columbus, Ohio. So I do my work in the middle of the United States, in the state that calls itself the heart of it all, and in a city that's right in the middle of it. And we are the only American research center focused on middle-standing enterprises. Most academic research is about startups or mostly about large organizations. There's almost nothing about middle-market companies, and we do primary research, giving grants to scholars. We do macroeconomic research. We do practitioner-oriented research, often survey-based, but focused on specific managerial challenges that present themselves to middle-market companies with particular power or in ways that are different from the ways they present themselves to smaller and larger companies. The first question we had when starting the center 5.5 years ago was defining what the middle market is. You find many different definitions, some using the number of employees, some using EBITDA. Definitions of the middle market sort of were created by, in many cases, banks defining an addressable market, or by public sector figures addressing an employee base, in other words, a number of voters. We decided that the middle market should be defined as the middle third of the private sector. Now, that will vary from country to country, but in the United States, the middle third of the private sector comprises companies with revenues between $10 million a year and $1 billion a year. Now, that's a large spread. We subdivide the middle market into two groups, 10 to 50, or three groups, 10 to $50 million a year, 50 to $100 million a year, and $100 million a year and up. And I suppose you can say that there is a maturity model in the growth of companies as they move across those transition lines. But that's how we define the middle market. There are 200,000 businesses in the United States with revenues between $10 million and $1 billion a year. And as I said, they account for about a third of private sector GDP and about a third of private sector employment. It's only 3% of companies, a third of private GDP, a third of private employment, and 60% of job growth. The point that I'm trying to make is that the middle market in the United States, which is often forgotten, startups get a lot of attention, big companies get a lot of attention, but mid-sized companies, the middle-standing enterprises of America, actually create the most jobs and are the point of the spear of the competitiveness of the country. Now, as we've studied mid-sized companies, we've tried to look at the secrets of their success and what distinguishes those companies that do better from those companies that don't do as well. And innovation is an absolutely critical factor in middle market company success. Innovation is the most often used tactic for middle market growth. You can see here that these are data from the first quarter of this year, that in the last 12 months, 40% of middle market companies introduced a new product or a service, and this year 42% say they are likely to. The second most common tool for expansion is expansion into new domestic markets, moving from Ohio to Illinois or from New York to California in terms of sales. The third is making acquisitions. I mentioned in the earlier session, most of these companies are private. Organic growth is their preferred means of growth. M&A is something that they are less likely to do. They don't like to go to the capital markets to fund acquisition. And expansion into international markets is the fourth most important. So if you look for one single tool for revenue growth in the middle market, it would be innovation. And then if you look again, and you look at the most successful middle market companies, the ones we call growth champions, that's the top 10% of middle market companies by revenue growth. You see significant increases in investment in innovation for these companies compared to the rest of the middle market. 66%, 2 out of 3 middle market companies invest in new processes. That's half again as much as the investment in new processes by the rest of the middle market. 54% invest in innovation and new product development compared to 29% for everybody else. And the number that I think is perhaps most significant here, 44% to 25%, have a dedicated annual budget for research and development. Now that's important because in these smaller companies with revenues of perhaps $50 million a year, continuity in innovation, continuity in investment in the future is important. Many smaller companies start with 1 or 2 products, and then they live on the revenue from those 1 or 2 products. But after a few years, they begin to realize that unless they start investing in a new product, in line extensions or whole new products and services, that revenue from their existing foundational product is going to disappear. Now, do they invest in a sporadic, ad hoc kind of way, or do they invest in a programmatic, systematic kind of way that says, we've got money every year, we've got a program, we've got a plan, we've got a strategy? And the importance of having a strategy for innovation is critical. I think that's the first big lesson that I would draw for middle-standing enterprises from the research that we've done. As these companies move into an innovative environment, into a world in which innovation is important for their growth, they need to do it with a plan. They need to do it with a plan, and they need to back that plan up with a budget. And if they can do those things, then they're on a stronger footing for moving into the future than companies that are less systematic in their thinking. Now, how much revenue, what percentage of revenue do middle market companies invest in innovation? This chart is a little bit hard to read, but basically across the top, you see the percentage of revenue spent by middle market companies in the United States on R&D, on research and development in the last 12 months. And as you can see, it kicks along at roughly 8%, a little more than 8% of revenue. It went down, it's gone down a little bit in times of when companies are feeling a little bit of stress, but basically it's about an 8.5% revenue. And notice how well this compares to the numbers on the bottom, which is the R&D expenditure by companies in the S&P 500. Those are the giant companies, the IBMs, the General Electrics, the Procters & Gambles of the world. So you can again see that the ratio of R&D to sales for middle market companies is pretty consistent with that for large companies. The question is not how much you're spending, but what you're getting out of it, how productive that research and development are. Now, one of the other things that's interesting is you ask what percentage of revenue do you get that comes from new products? I don't have data that show this for the whole middle market, but what I can show you is that roughly 25%, 1 out of 4 middle market companies, gets more than 20% of its revenue from products that are new, the products that were introduced in the last 2 years. So that's a substantial number of companies, 1 out of 4, that are creating a lot of value from research and development. So we're seeing a pattern of investment. We're seeing a pattern of, in some cases, very productive investment. And we're seeing that the most successful companies invest in a programmatic, systematic, strategic way rather than just going about it ad hoc. In what do they invest? Now, this is an interesting chart. We asked companies, what kinds of innovation have the biggest impact on performance? Because remember, you can innovate in a lot of ways. Sometimes when we think of innovation, we think of a mad scientist in a lab coming up with new products and services. But there are many other kinds of innovation. You can improve an existing product or service. You can develop a new business process to improve profitability. You can develop entirely new products or services, or you can develop more sustainable and eco-friendly processes and services. You can develop entire new business models, right? Uber and Lyft are not really innovative. They're innovative business models, but the technology itself is not innovative. It's just adapted from other technologies. Or you can develop new strategic partnerships, which may involve working with cloud partners, working with companies that are aggregators or on platforms. So there are different kinds of innovation. And the question is, which has the greatest impact on performance? Remarkably, and we'll go into this in some detail as we go further, 32%, 1/3 of middle market companies say the most productive innovation is not brand new stuff, it's making old stuff better. Improving my existing products and services is where I get the most bang for my innovation buck. I get the most productivity from innovation. The second most important thing is improving processes. It's only when you get to the third most important kind of innovation that you see the development of entirely new processes and services. So as you think about 200,000, 20,000, however many middle market companies looking at this vast, challenging, changing technological landscape and looking about where they're going to put their money to get the most effective innovation, the first opportunity to look at is how can I innovate to improve what I've got? And the second opportunity to look at is how can I make it better or deliver it better, improve the processes by which I construct or deliver my products or my services. And then look for the brand new products or services. Now, what's interesting is this varies by company size. You'll remember that I said that we look at 3 different groups of middle market companies. Those with revenues between $10 million a year and 50, which are sort of like small businesses in size. Those between 50 and 100, which we call the core middle market. And then the large middle market, which is companies with revenues between $100 million and $1 billion a year. One way of thinking about these 3 segments is that first group are like big small businesses. And they are just in the process of creating functions. We started out as a bunch of us around a table, as I said this morning, but now I have to hire a chief financial officer, a chief marketing officer. I have to build a human resources function. The second group in the middle have functions, and they're in the process of getting those functions rich and strong, and they move to the third group, the large group, when they create divisions, when they have more than one P&L, when they have different business units with different profit and loss statements. So we have the large small enterprise, the fully functioning mid-sized enterprise, and the enterprise that is on the way to becoming a big company. And take a look at the different emphasis on innovation. Those smaller companies and the bigger ones, on both sides, those are the ones that are most likely to invest in improving the products that they have. And if you look then at the investment in new business processes, that comes in the middle. That's most important in the middle, which is that place where companies are starting to build functions and get those functions big. So they're trying to struggle with the management of the enterprise that they've built. And so what you see is a really interesting variation in the importance of innovation depending on company size. Now, this also varies by industry. You can look at different cuts in the healthcare industry or in manufacturing or in services or in retail, but the size differential is a really important way of thinking about how executives should approach the challenges of innovation and the challenges that the fourth industrial revolution presents to them. As these companies look at this, they also have to look at their internal capabilities in an important way. And that is to think about, what do I need to do if I'm going to innovate more successfully? And what do I have in the way of capabilities? The chart here shows what the 5 capabilities that mid-sized company executives tell us are most important for innovating. They need to understand their customers. That's the most important thing. I need to know for whom I'm innovating. I need to have the right talent. I need to adopt new technologies. I need to collaborate externally with universities, with other businesses, with channel partners, and I need to encourage creativity. Those are the big red bars. Look at the brown bars below. These are the gaps. I need 71%, 72% of middle market companies say, I need to understand my customers better. But only 23% say they really do understand their customers well. 71% say they need to have new and better talent for innovation. But only 18% say they actually have the people they need. So these companies, as they face this changing landscape, and as they face all this opportunity, also see big gaps in the capabilities that they have in order to address those opportunities. So that's sort of the capabilities question. And you see, first of all, what I was talking about at the beginning about the importance of innovation and how the most important middle market companies build a capability with a budget and with a plan, and how they focus that innovation where it will get the most value, and how they see large gaps, particularly in the areas of talent, and talent and understanding customers in order to make that innovation work. But now I want to talk a little bit about innovation portfolios. A lot of research about innovation has been conducted with big companies. Let's take a look at Procter & Gamble. Let's take a look at IBM. And let's take a look at a big pharmaceutical company, and let's think about what they do to innovate successfully. And a lot of that thinking has involved portfolio theory. The idea is, I'm going to have 100 innovation projects, and 10 of them are going to be really way out there. They're going to be very experimental. They're going to be highly risky, high risk, high reward, take a flyer kinds of innovation, and others will be closer in, will be more familiar and on safer ground. Portfolio theory is a classic way of managing innovation for large companies. Is it helpful if you're a middle market company? No. A typical middle market company has 3 innovation projects in a year. You can't do portfolio theory with 3 innovation projects in a year. You need to pick your projects carefully, and you need to make sure that their likelihood of success is very high. Companies with few projects and narrow portfolios cannot easily diversify their risk. So how can you make decisions if each of these is a risky project? And how do you think about this in terms of a fact that I mentioned this morning, which is that most of these companies are playing with their own money. It's the family's money, or a private equity firm's money, or it's the owner's money, right? But they have the typical middle market company in the United States is 31 years old. Failure is not an option. They need to survive. They need to take risks in this landscape, but they need to take risks in a safe and conservative way. How do they do it? We did an interesting study about among the things that middle market companies do. I'm not going to go into the details of it here, But one thing that the most successful innovators do is they listen very, very well. They make sure that they talk a lot internally. They make sure that the chief marketing officer and the chief sales officer and the chief financial officer and a lot of people are in the room to discuss innovation. They collaborate well with outsiders. They talk to universities. They go to conferences. They participate in technical groups. So they try to get a lot more information. The more successful companies in mid-sized companies learn a lot, think a lot, and listen a lot before they make one of those 3 investments that are so critical to their businesses. But the other thing that's interesting is to look and see where they're putting their money. Now, I've changed the color scheme a little bit because we're from the way we published this originally, because we're in Korea, and I wanted to make sure I had a red ocean and a blue ocean for you, and all the good work that Chan Kim and Renee Moborn have done about red ocean and blue ocean strategy. It's possible to think about innovation in 2 dimensions. Am I using knowledge I already have, existing knowledge, or am I going after new knowledge? And am I selling to existing markets, or am I selling to new markets? So I can take existing knowledge and sell it to new markets. I can take take new knowledge and sell it into existing markets, or I can go out there in a blue ocean with new knowledge into new markets. If you take a look at the middle market as a whole and ask, as we did, what was your last innovation project? 48%, half of those projects were existing knowledge to existing markets. They were innovating right here, right at my feet. The grass is right green here, and I'm going to put my money where I know, to customers I know, with science that I know or technology that I know, and innovate there. Only 9%, less than 1 out of 10, put their money into blue oceans. Now, what's also very interesting is that these companies on the left-hand side of this slide did very well with those conservative innovations. You would expect a classic economist, a classic economist's analysis would say that those red investments would not pay off as well as the blue investments. But for these companies, they did. Now, you can conclude one of 2 things. Either there's a lot of very good investment in that red space, or these companies are very bad at investing in blue oceans. And that turns out to be the case. If you look at the better middle market investors, middle market innovators, you see a big shift. Only 37% invest in that existing red ocean space. Twice as many invest in that blue ocean space with new knowledge brought to new markets, and their returns are substantially higher. In other words, risk and reward, the big trade-off in innovation, does not work as well for these inferior innovators. So they're cautious, and they take little steps, and they make small innovations, and they get a pretty good return on those small innovations, but they leave big opportunities on the side. So top innovators create and capture value differently. They're more likely to invest in projects that explore new knowledge or new markets. They are more likely to have formal processes to generate, select, fund, and implement ideas. They are more likely to involve a lot of top executives across the executive suite, and they are more likely to talk to people outside the company, to include outside sources to test or to develop new ideas. The less successful innovators are more likely to invest to reinforce existing knowledge in markets. Many do not have formal processes in place. There is a left tail in terms of who's involved, with very little involvement from the rest of the C-suite, and innovation is primarily conducted in-house. So you see a big difference. That difference I mentioned earlier, and this morning I talked about a confident mindset, a mind that wants to expand, that wants to explore the world, that wants to get out into the world. It shows up the same way in innovation behavior, and leads me to a very simple conclusion, that if you're going to go out on wild roads, you better have a really terrific car. Thanks very much.